Okay, hi, let's do question 5. So this is an area we talked about. Again, always good to do some revision on this as well. But I'm going to go through it slowly so you can see what's going on here. First of all, the first thing I want to say is that we do not use marginal costing for reporting purposes. The issue here is really to do with the valuation of inventory. Only absorption costing for manufacturing organization is the method used for arriving at the standard cost of an item, right? The standard cost of an item, because it includes the fixed, if you like, manufacturing costs, or the manufacturing costs in the factory. Because if you're making an item in a factory, it should include all the costs in the factory. We've seen from earlier questions are included. Marginal costing is used for decision making. Are we breaking even? Are we meeting those fixed costs? So it's completely different sort of thinking. In effect, it's just a way of us looking at what we need to do in order to meet our fixed costs. I mean, there are other decisions that we can make as well with marginal costing. If once we've met our fixed costs, then we can carry out, I guess, gentle business engineering. We can reduce the selling price as long as we're covering our variable costs, because we don't have to think about our fixed costs anymore. So these are the kind of things, like I think I gave the example. I think with, again, imagine you paid rent of £1,000 for the week, and by the first 2 days, you had made enough to cover that. So whatever, if you're selling things at £100, that costs you 50. Your variable cost, your selling price, that's your contribution, which is 50. If you sell 200 items in the first 2 days, you've covered this. So the question is, going forward, in order to gain market share, you could just reduce your selling price, maybe to 75, to 60, whatever, as long as it's above 50. And so it's a matter of volume, isn't it? Imagine you brought this down to £51, your selling price of £51, and you're making £1, and there's enough supply. You're able to get as much as you can, and you're suddenly able to get a market of 1 million people. Well, that's okay. The cost is still £50. That's not going to change. You just got new volume, so you're going to make more profit. The only reason why we sell for £100 typically is because we just can't get the volume. Otherwise, we'd drop the price, sell just above the variable cost. If we can capture all the volume, we're fine, which is how, if you like, in effect, monopolies can, well, in effect, monopolies can do what they want. But the whole idea is, if you drop your price, you're able to gather as much volume as possible. Okay, great. So let me just kind of do that. Let's do that here and see how this applies here with this question. So with absorption costing, because of what I said, because we're including, let me just change my pen color here, because we're including all the costs here, let's look at what's going on here. So we're told here that in February our selling price is 90. So you're thinking, okay, great, that's 90. Great, thank you very much. And then it says here that your situation is that your variable cost of making a unit is £55. Okay, so thank you, 55, that's variable cost. And remember, I'm dealing with absorption costing first. With absorption costing, we bring in, I mean, to be fair, they have been slightly clear here. You see this fixed cost, because you have non-manufacturing fixed cost, I sort of know that this is a manufacturing. It is inferred manufacturing fixed cost. I know that. I'm sort of given that information because I'm given this is non-manufacturing. Remember, I'm in the factory first of all. I'm talking about what's going on in the factory first. So regarding the factory, this is my fixed cost. Now, again, like all things, I do it based on an absorbed level, because my normal production level is 100 units, and I have fixed costs of 2,000. So I am going in, if you like, at £20 per unit in terms of fixed costs, because this is it's all absorbed, sort of cost absorption rates in effect. So I'm going to go in at £20, if you like. That's going to be my plan. So my fixed cost, if you like, per unit, so to speak, or my overheads are £20. So in effect, giving me, if you like, a full cost, if you like. This is a fixed cost here, or overhead cost, direct overheads, if you like. Giving me a full cost of £75 per unit. So let's look at what happens. I don't have any inventory at the start of the year. I then produce 110. So I make 110 units. So that's 75. Again, 75 times 110 gives me 8250. Okay, thank you very much. Now let's just be careful here again. So I've made this. I currently have put in a full cost of 8,250. Remember, I've put in £20 times 110 units. That's what I mean. I've made this during the year. So basically, I've put in 20 times 110, and that is 2,200. That's what I've put into my accounts so far. But I am told the fixed costs are actually 2,000. Right. Remember, it's just an accounting thing. So what does this mean? In effect, what I have done by default is that I have put in 200 too much. So I have overabsorbed and I need to deduct that overabsorption. This is just, we're just pretending we're in real work. I've put in, as I'm making the units, I'll put in £20, so to speak, the £20 from here, but that's altogether 75. But now I realize at the end that my cost is actually overabsorption. And that overabsorption is 200 because I've put in £20 for 110 units that I've produced. I've made 2,200, and therefore I'm going to have to deduct this 200 from this 8,250 to get the real, if you like, cost of sales, which is therefore 8,250 minus 200, which is 8,050. Okay, great. So what do I have now? I have opening inventory of nil. I have, if you like, my production, and I'm told that my closing inventory, of course, is well, it says that we sold 95. So if we produced 110 and we sold 95, it means we have 15 left, right? So my closing inventory, of course, is still the full cost. You see, that this is where I'm getting to. This is all about valuing closing inventory. Your value of closing inventory right now is 75 times, because it must be the closing inventory must be at the full cost of what's going on in the factory, which is 75, right? So I have 75 units that are sitting now at well, sorry, 15 units that are sitting at £75. Of course, that's my closing inventory because I haven't sold them, but that's £75, and that's 1125. I better write that here, 1125. So my technically my cost of sales, if you like, is the production adjusted for the, if you like, the over absorption on the fixed overheads, less my closing inventory, which gives me 8050. 8050 minus 1125 is 6925. So my cost of sale, the cost of the 95 units that we sold, is 6925. Now let's look at this. If they cost 6925, how much did I sell them for? Well, there's £90. You sold each of them for £90. You sold 95, which gives you 8,550. So if you sold them 8,550 and they cost you 6925, your gross profit technically 8550 is 1625. Okay, great. Thank you very much. Then you're told you have these non-manufacturing costs. So now I have my non-manufacturing, if you like, of 1,200. Take that off, and you get 425, and that brings you here. I mean, this is a video, so I'm going to rub this out. So that's how we get there. Now, let me look at the marginal situation. You see, what marginal is saying, like I said, is that marginal is saying marginal doesn't recognize. It's because it's a different tool. It's not trying to prepare accounts. It's not trying to value closing inventory. It's just trying to understand decisions on how I would make decisions if I was only focusing on the contribution. Right? That's the issue. It's just a different way of thinking. So marginal costing says, okay, listen, focus just on the contribution. Well, you sold each unit for £90. Um, each variable unit costs 55. You can see I'm literally focusing purely on the contribution of £35. This is what, so in effect, in a way, you can see here that at this rate, if I say, okay, well, how many did I sell? Because I mean, what the question is still how many I sold. I sold 95, right? Each unit is currently at £35, valued at £35. Sorry, each unit is currently valued, each cost unit is currently valued at 55. So technically my closing inventory, it will be valued at 55. So you can see why we do not use this method at all for actually preparing accounts. It's not valid for preparing accounts, but it's valid for making decisions. So I'm getting 35 on each. I've sold 95. So 35 times 95 is 3325. So you can really see what's going on here, the point of this. So the whole idea here again is that my fixed costs, all my fixed costs are just considered fixed. So I have fixed costs here of 2000 and I have fixed costs here of 1,200. I'm just trying to understand how much or how quickly can I cover my fixed costs. Fair enough, when I go into the next period, my opening inventory is at £55 per unit. This is critical for understanding question 6 when we come to do it. But as far as this is concerned, that's my contribution. Those are my fixed costs. So my fixed costs are treated as we would say, period costs. They just happen in the period. We don't integrate those. We don't absorb those costs over our units because we're just trying to understand. We're trying to actually cover them. So we need to keep them separate. And when you deduct these two figures from this, you get 125, which takes us to B. Right, good. So, question 6. So this question is asking in an accounting period, when the level of sales is greater than the level of production, which would lead to a higher profit level of profit. And this just requires some understanding of what's happening with cost of sales. So let's look at it like this. When you have the simple way of looking at it like this, when you have opening inventory, if you like, let's look at when you have so imagine I started my year and I did something like I did this. I had opening inventory of 10 items, and then I had purchases of another 100 items, and then so look at what I'm going to do here. Imagine my closing inventory was I had 50 items, or let me say 60 items left. So my cost of sales, right, is pretty small. I have 10 plus 100, that's 110, minus 60. My cost of sales is 50 items, right? So, and remember this, in absorption costing, this this closing inventory includes, for example, those fixed costs, as opposed to with marginal costing, it didn't. So really, so imagine this 60 here was times 75. This is for absorption, but for marginal, it was times 55. So first of all, I managed to get rid or hide some of the costs in here with my absorption costing, if you like. They're in here and they don't get deducted in this period. They don't get deducted in this period. But you see that £25 here, that £20 period costs here got deducted in this period, all of it, if you like. So, the issue here is that, what I'm really trying to highlight is that it's not running away. It's not going to escape. But for the period here where you have this type of scenario where you have a high closing inventory, where you have lots of closing inventory, absorption costing gives you higher profits because their cost of sales is less. If you like, you sold whatever, say whatever, 100 times 100. So I mean that's the same thing for marginal costing. I'm just going to put marginal costing method here. They both have the same sales, but your costs are less. Your cost of sales is less with absorption costing because you have your closing inventory is higher. As a result of that, your cost of sales is lower, so your gross profit is higher. Right? So lower costs of sales, of course, lower costs of sales gives you higher gross profit because one, you've been able to move this, you've got this, and also because you're not putting through all the costs in the in that period as well. But the drama, and here, of course, here that the because so when your closing stock is high in this manner, your gross profit is higher with absorption costing. But you see, this doesn't end. You see, because what happens is this is what this question is asking about. In the next period, this cost here will now turn up. So closing inventory in one year becomes opening inventory in the next. So now you have this massive cost of opening inventory. It's now a cost. It is there. So imagine you now have this 60 times 75. It's a cost. But marginal costing, if you like, will have it, say, 60 items times 55, your opening inventory for marginal costing. So your costs are less when you go into the next period. And the reason why they talk about why the level of sales is higher is because we're actually getting rid of the closing inventory from the last period. We're selling it. So we're going to get rid of this opening inventory. And in fact, that's what this question is really saying. What happens when you now get rid of that closing inventory of the last year? Your sales are actually high. You're keeping little inventory now. In fact, it's all going. In fact, imagine this is all we did. Imagine this is all we did. Our sales are higher than production, so we're getting rid of that um, production. Remember, we're not making as much because we have to get rid of the closing inventory we had. So now your costs increase in this period for absorption, but your costs are less. So in effect, because your costs are less, you're still selling for the same prices. So because your costs are less for marginal costing now, in the next period, your profits are higher in marginal costing, but much lower in absorption costing. So the answer here is that when the level of sales is greater than the level of production, um, the marginal costing approach will lead to higher profits only because we're just moving costs along. Right, only because we're moving costs along. So to summarize, in effect, the key point really here is to do with the fact that with with um, with absorption costing, we're able to, in the first period, typically when production is greater than sales, we're able to hide the costs in closing inventory and shift them to the next period. So for this period at least, our costs are less and our profits are greater. But of course, suddenly you get to the next period, those costs appear as opening inventory and there's nowhere to hide. So suddenly those costs are now there and therefore your profits are less. But with marginal costing, because you've kept the costs the same all the way, you will now have higher profits when compared. But overall, they will be exactly the same. Cool, great stuff. That's taken a while. Apologies. So the answer there is marginal costing.